In this module, we're going to give you a brief overview of the entire course of financial engineering and risk management. We'll introduce the ideas of financial markets, financial products, what do financial markets and financial products do for you. We'll introduce the ideas of the main problems in financial engineering and how these relate to the different issues that come up in practical applications of financial engineering and risk management. Why do we need financial markets? Financial markets enable efficient allocation of resources both across time and across states of nature. What do you mean by across time? What we mean is that you have income available today, but you want to allocate that income for some time in the future. You have income available today, but tomorrow the states of nature are uncertain. You don't know whether you would have income available there. You don't know what your costs are going to be in the future. Depending upon various events happening, you might need more or less amount of funds. And financial markets allow you the possibility of taking funds that are available today, move them across time, and move them across to states of nature that are uncertain. A young worker with a high salary right now, what should she do? If there are financial markets available, she could invest in stocks and bonds to finance retirement, home ownership, education, and so on. If there were no financial markets available, she would have to, such as a home, car, and so on. But she's not going to be able to move that later on in time to have them available when the states of nature are not good. This idea of states of nature actually becomes more clearer if you consider the example of a farmer producing oranges. The farmer is producing oranges and she is open to the risk of the price of orange when her product gets ready and it goes into the market. If there were financial markets available, as they are right now, she could hedge the price of the oranges in the future using a futures markets. She could also buy weather-related derivatives and use these derivatives to protect against the possibility of her produce going bad as a result of a freeze and so on. If there were no financial markets available, she would be open to the vagaries of the spot market. She cannot hedge the price, nor can she hedge against the uncertainty of her produce not coming through because of some weather-related emergency. What do markets do? They essentially do three things. They gather information. Markets are a place where buyers and sellers come together. They take action based on their information. This information gets aggregated, and that aggregated information gets reflected in the price of the product. And in some sense, this information gathering is necessary in order for a fair price to be created. It aggregates liquidity. So there are many buyers and sellers for a particular product. If there was no market, the buyers and the sellers would have to go looking for a counterparty, looking for a person who wants to take the opposite position. With a market, all the buyers and sellers come together, the liquidity gets aggregated, and as a result, both the buyers and sellers get a better price. By gathering information and by gathering liquidity, markets introduce or promote efficiency and fairness. What about products? Financial products are created to satisfy needs. Products hedge risk. They also allow for speculation. Products allow one to raise funds for an operation, for example, by issuing shares in an IPO. They also allow you to fund liabilities. Financial markets can be modeled in several different ways. There are two standard market models that are out there. One of them is called a discrete time model, in which time goes forward in discrete steps. There are single period discrete time models and there are multi-period discrete time models. The other class of model is called continuous time models. Continuous time models, time does not advance discretely but in a continuous fashion. The pros and cons of discrete time models are as follows. The good thing about a discrete time model is that it's simple. We can introduce all important concepts with very easy mathematics, much less sophisticated mathematics than is necessary for the continuous time model. The problem with discrete time models is there are no closed form solutions possible. The solutions are not as elegant as those available for continuous time models, and one has to resort to numerical calculations. This used to be a problem when computation was hard and you couldn't do sophisticated computation on simple machines. But as the price of computers have been coming down, people have tended to move more and more into discrete time models because they are simpler. You can introduce all kinds of interesting effects and compute them rather than trying to look for a closed form solution. The focus of this course will be on discrete time multi-period models. We want to keep the mathematics simple and yet be able to introduce all the concepts that are necessary for you to understand financial engineering and risk management. There's a little bit of a caveat. Very, very few continuous time concepts will be used. For example, the Black-Scholes formula, which comes from continuous time analysis, will be introduced because this is a very classic formula and anyone graduating from a course on financial engineering and risk management ought to know this formula. Another topic that's of interest is what's the difference between financial economics and financial engineering? Financial economics is concerned with using equilibrium concepts to price something called primary assets. These are equities, bonds, interest rates, and so on. Financial engineering, on the other hand, assumes that the price of the primary assets, such that equities and interest rates, are given, and the focus of this field is on pricing derivatives on these primary assets using the no arbitrage condition. But this distinction between financial economics and financial engineering is by no means a complete separation. For example, the capital asset pricing model, which prices assets, is of interest to both financial engineering and financial economics. There are three central problems of financial engineering: security pricing, portfolio selection, and risk management. The main focus of security pricing is to price derivative securities such as forwards, swaps, futures, and options on the underlying primary securities using the no arbitrage condition. The focus of portfolio selection is to choose a trading strategy to maximize the utility of consumption and final wealth. It turns out that portfolio selection is very intimately related to security pricing, and this will become clearer as we go through the course. Single period models such as Markovitch portfolio selection are very widely used in industry. Multi-period models are much harder but starting to get more traction. There's also the issue of pricing and using real options, such as options on gas pipelines, oil leases, and mines. These are also part of a portfolio selection strategy. The third important topic is risk management, and the goal of this area is to understand the risks inherent in a portfolio. Here, we are not trying to choose a portfolio. The portfolio is already given. We just want to stress test the portfolio to understand how it performs in different market conditions. The important topics that come up in risk management are tail risk, which is the probability of large losses. Two risk measures that have become very important for tail risk are the value at risk and the conditional value at risk. These two risk measures were introduced for risk management but have started to become much more important for portfolio selection as well. Financial engineering has led to some very interesting problems in applied math and operations research. For example, how does a company manage its operational risks using financial products? This is a marriage between supply chain management on one side, which is one of the core ideas in operations research, and financial engineering on the other side, which talks about risk management and portfolio selection. You bring the two together, and now you have the possibility of hedging operational risks, which have got nothing to do with financial engineering per se, and combining them with financial products to get an idea of how one could hedge the risk across different areas. This module is the first of three modules where we will be walking through the main theoretical ideas behind mean variance portfolio selection. We'll first define what a portfolio is. We'll talk about what the return and risk of a portfolio is going to be. We're going to define what an efficient frontier is. We're going to define how an efficient frontier changes when there's a risk-free asset and how all of that leads up to the capital asset pricing model. The overview of what we're going to be talking about here is that we're going to define assets. We're going to define portfolios. We're going to define how to measure random returns on assets and portfolios. And for the mean variance optimization, as the name suggests, we are going to quantify the random asset and portfolio returns by their mean and variance. We're going to define something called mean variance optimal portfolios or mean variance efficient portfolios. We're going to define something called the efficient frontier and the portfolios that lie on this efficient frontier. How does one compute them? Along the way, we are also going to talk about Sharpe ratio and Sharpe optimal portfolios. We're going to define something called a market portfolio, and after defining the market portfolio, we'll get to something called the capital asset pricing model. These are the various modules that we're going to be walking through in this bigger topic of mean variance optimization. So what's the goal here? What I really want to do is I've got a certain amount of money and I want to split it among various assets that are available for investment. I'm going to characterize an asset by its price. More often than not, I'll be interested in returns on these assets. I'm going to invest in them today. I'm going to sell them tomorrow, and whatever difference is the return that I make on it. And I would like to maximize this return in some appropriate sense. So I'm going to define the random gross return on a particular asset to be simply the price one time step later. A time step could be a quarter, could be a year, could be 6 months. So it's PT plus 1 divided by PT. The net return is simply RT minus 1. It's going to be PT plus 1 minus PT divided by PT. I want to point out that both RT and little rt are random quantities. These are random because the price at time t plus 1 is random. Price at time t, which is right now, is known, but the price at time t plus 1 is random, and therefore these returns are going to be random. I've got d different assets, and I want to split an amount, capital W, that I'm going to assume is strictly positive. This is the capital that I have, and I want to split it over the d assets that I have. W sub I will be the total dollar amount that I've invested in asset I. If Wi is greater than 0, I'm going to say that that's a long investment. If Wi is less than 0, it's going to be a short investment. For the purposes of modeling, we allow W to be both positive or negative. R sub W will be the net rate of return or net return on the position W. By position, I mean the wealths in the various assets. So what is the definition? It's simply the total value of this one-time step later, which is the gross returns on each of the assets times the amount of money that was put into those assets, minus the initial wealth, which is sum of the W's, divided by the initial wealth, which is capital W. If you do the math, this 1 can be subtracted from Ri, and you end up getting this is going to be the net return little RIT, Wi, divided by the sum of the Wi's. You rearrange them a little bit, and you end up getting that the net return on position W is the net return on each of the assets RIT, which is a random quantity, times Wi divided by capital W. So what is important to the net return is not the absolute amount of wealth that is invested, but the relative amount or the fraction of the total wealth that is invested in a particular asset. So instead of worrying about positions, we just have to consider a portfolio vector. So X is a portfolio vector. It could be positive or negative. Xi's represent the fraction invested in a particular asset. So sum of the Xi's must be equal to 1. One thing that I want to point out here is I've been talking about time t. In reality, the return that you get, whether it's the gross return or the net return, changes over time. The random properties change over time. The actual values that are realized change over time. But in this set of modules, we are going to be looking at a very myopic investment strategy. I'm sitting at a particular time t. I only want to invest at time t plus 1. When we get into more advanced topic, we're going to talk about how to extend this idea to a multi-period optimization. People are interested in multi-period optimization because at the end of the day, they want to save money for retirement, want to save money for buying a house, and so on, which is not a one-period problem, but a multi-period problem. A multi-period problem is not simply a concatenation of one-period problems because the space over which you can optimize becomes much larger when you look at multi-period problems. But in this set of modules, we're going to be concerned only with one-period optimization, 1 quarter, 1 year, and so on. So how does one deal with randomness? The return on the portfolio, R sub X, is going to be defined as Ri Xi. And notice over here, I've dropped the Ri, the time in the Ri, because I'm focusing mainly on myopic optimization. This is a random return. Why is it random? Because each of the net returns, Ri's, are going to be random. How does one quantify these returns? Should I simply look at maximize the expected value? Is that the right thing to do? Should one be worried about the spread around the mean? So the expected value or the mean value tells you what happens when you repeatedly invest. Most of us don't have the ability to repeatedly invest. If we go bankrupt, our investment is over. You don't have the ability to return from bankruptcy, then you might have to worry about what happens to the spread around the mean. How does one quantify the spread around the mean is going to be a question that we'll have to deal with. The way we're going to do this in these set of modules is we're going to talk about the mean, and we're going to quantify the spread around the mean by the variance. So the values defining the asset returns are going to be the mean return, which is the expected value of the net return, the variance of the asset return, which is simply the variance of the random variables. Notice the mu i's and the sigma i's are assumed to be independent of time. Again, either the market itself is stationary, or we are only interested in myopic investment, therefore we don't have to worry about time. The covariance between the asset return is the covariance between a random return on a particular asset I and an asset J. Correlation, again, it's between two assets, and there's a relationship between covariance and correlation. Covariance is nothing but the correlation times the volatility of asset I and the volatility of asset A. All parameters are assumed to be constant over time. Now, I'm going to characterize the random return that I get on a portfolio by looking at the expected return of the portfolio and the variance of the return on the portfolio. So the expected return on a portfolio X, mu sub X, is going to be the expected return on the net return of that portfolio, R sub X. By using linearity of expectations, we end up getting that this is nothing but the expected return on each of the assets times the fraction invested in that asset, Xi. So it's just mu I times Xi summed from I going from 1 through D. The variance of the return, again, just by the expression, it's the sum of Ri times Xi, the variance of this random variable. And if you expand it out, it becomes the covariance of Ri and Rj times Xi Xj. Here's just a simple example to try to work you through it. So I have two assets with normally distributed returns with mean mu and variance sigma squared. So R1 is one asset. It has a mean 1, and it has a variance 0.1. R2 is another asset. It has a mean 2 and has a variance 0.5. The correlation between these two assets is negative 0.25. So if you translate this statement into those parameters, mu1 is 1, mu2 is 2, sigma 1 squared is 0.1, sigma 2 squared is 0.5, sigma 1, 2, which is the covariance between R1 and R2, is going to be the correlation, whose number is right here, times sigma 1, sigma 2. You plug in the answers, you'll end up getting it's 0.0559. In the two-asset market, portfolios are very easy to define. Remember, portfolios were the fractions invested. So if I invest fraction X in asset 1, and since the fraction invested in asset 1 and the fraction invested in asset 2 must add up to 1, I should invest 1 minus X in asset 2. Later on, we will see how we can use this X 1 minus X to try to do efficient portfolio selection between these two assets. Plugging it into the formula, the expected return on this portfolio is going to be sum of mu I xi 1 through d. Two assets. The first asset has x. Its expected return is 1, so it's 1 times x. The second asset has 1 minus x. Its expected return is 2. So the total expected return that you get on this portfolio is x plus 2 times 1 minus x. What is the variance associated with the return of this portfolio? The formula is sigma ij xij xi xj summed from I equals 1 through d, which can be equivalently written as sum of I going from 1 through d sigma I squared xi squared plus 2 times j greater than I sigma ij xi xj. Plugging it in, 0.1, which is the variance of the first asset, times the investment in the first asset squared, 0.5, which is the variance of the second asset, times the investment in the second asset squared, 2 times the covariance between the two assets, which was just computed here, times the investment in the first asset and investment in the second asset. This exact thing can be generalized to multiple assets, and that is what we'll do in later modules. In this module, we'll work through the mathematics of computing the efficient frontier. Remember, efficient frontier was an idea that we had introduced in the previous module. It's the frontier between what is achievable and what is unachievable. So it's the frontier on which we always want to stay. If you remember, what we said was for a given level of risk, the efficient frontier gives you the maximum possible return. So this is the efficient frontier. This particular point corresponds to the return of a portfolio, which is an efficient portfolio, or it's a frontier portfolio. All of these things are synonymous. It's a portfolio that for a given level of risk gives you the maximum return. Or another way to look at the same point is that for a given value of return, this portfolio gives you the minimum risk. So any investor wanting to hold a certain amount of risk or wanting to hold a certain amount of return will want to be on this efficient frontier. And in this module, we're going to walk you through the calculation of how this particular curve is computed. We're going to work with a very simple example first, just of two assets, two risky assets, and then in the later part of the module, we'll show you that that is the most general. In fact, if you have n assets, any number of assets, you will end up using only two mutual funds to construct the efficient frontier. So here's my problem. I want to do mean variance optimal portfolio selection for a two-asset market. Asset 1 has mean return mu1. It has variance sigma 1 squared. Asset 2 has mean return mu2 and variance sigma 2 squared, and the correlation between the two assets is rho. What's nice about a two-asset market is that the portfolio constraint is very simple to write. A portfolio, remember, was the fractions invested in the different assets. So in a two-asset market, there's only one unknown x. Suppose x is the fraction that you invest in asset 1, then 1 minus x will be the amount you will invest in asset 2. And therefore, the return of this portfolio, x1 minus x, is going to be the mu1 times x, because that's the amount that you invest in asset 1, mu2 times 1 minus x, because that's the amount that you invest in asset 2. What is the variance of this portfolio? It's going to be sigma 1 squared times x squared. That's the variance coming from asset 1. Sigma 2 squared times 1 minus x squared, which is the variance coming from asset 2, plus 2 times rho sigma 1 sigma 2. And if you go back, this is nothing but the covariance sigma 1, 2 between the two assets, times x, the amount invested in asset 1, times 1 minus x, the amount invested in asset 2. It's very simple. It's one-dimensional in the sense that the only unknown is x, and that's why two-asset markets are very easy to describe. So I want to solve a minimize risk formulation for the mean variance portfolio selection problem. So what I want to do is specify a target return and then find a portfolio that achieves the target return but has the minimum risk corresponding to that target return. If you look back into the module that we talked about before, in the formulation we said that this is the return of the portfolio. This is mu of x. We wanted that to be greater than equal to r. Here we are saying that this is exactly equal to r. So there's a difference between these two. We wanted it to be greater than equal to r, and we are now wanting it to be equal to r. The reason we made it equal to r because it's very easy to compute. One equation, one unknown, I can solve for x. I can plug that x into the expression for the variance, and I'll get the efficient frontier. But this fact that I want it equal to r will come and affect us in the final solution, and we'll have to reinterpret what that means. What we're saying is, among all those portfolios that give me a return exactly equal to r, find me one which has the minimum variance. For a two-asset market, this becomes trivial because there's only one unknown x, and I can solve for it. So there's only one portfolio that gives me the desired return r. And what's the value of x? It's simply r minus mu2 divided by mu1 minus mu2. You simply solve this one-dimensional equation and you'll get the answer. So I know the portfolio x that is going to give me the target return. I'm going to plug it into the expression for the variance. So if x is r minus mu2 times mu2 minus mu1, 1 minus x, which is the amount that you invest in asset 2, is going to be mu1 minus r divided by mu1 minus mu2. You can just do the algebra and it'll turn out to be right. So what I've done in this line is that here I've just said x, so it's sigma 1 squared x squared. Here I put in 1 minus x, so it's sigma 2 squared, 1 minus x squared. This is x, this is 1 minus x. If you plug in the answers, you'll exactly get this expression. If you expand it out, you'll end up getting that sigma r squared is ar squared plus br plus c. So these are just numbers that depend on sigma 1, mu1, and rho, and sigma 2, mu2, and rho, and so on. But these are numbers. R is the only unknown. So what does this tell me? It tells me two things. If I know the target return r that I want to get to, the variance, the minimum variance corresponding to that target return is explicitly given by a formula. In fact, it's given by a parabola. I don't want you to focus too much on the fact that it's a parabola. Sometimes it'll become useful. For now, the only thing I know is that you give me the value of r, I know the minimum variance, and therefore I can create the mean variance efficient frontier, and which is exactly something that I'm going to draw on the next sheet. So what am I drawing here? I'm taking a value of r, and how was this computed? I plugged this value of r into that formula. I calculated out what sigma r squared is going to be, took a square root of that, that's going to be volatility. So I'm plotting r in percentages here, I'm plotting volatility in percentages, and this is exactly for the same set of assets that I showed you on the spreadsheet. When we are done with this module, I'm going to go back and show you how to do the same computation on the spreadsheet. And so I compute out what sigma squared r is going to be. It's going to be this number. And I'm going to plot this for all possible values of r. Notice on this slide, I'm plotting two different curves. One in blue, one is red. The red curve is not efficient. If you take a point here, this has a return of minus 2%. It has a volatility of, let's say, approximately 8%. We can get another portfolio with the same risk level, 8%, with much higher return. This particular portfolio up here has the same risk level, 8%, and has much higher return than this minus 2. So this entire red curve, in fact, is not efficient. And that's what it's been marked out. It says that it's inefficient. So why did we end up getting it? We ended up getting it because when we set up the optimization problem, we insisted that the target return should be exactly equal to the return that I specified. If I had made it greater than equal to, and you had specified a return minus 2, the optimization problem would have discovered that for that particular target return, the best risk is this 8%, but for the same 8%, I can give you a much higher return, and therefore this bottom line would never have appeared. The bottom line appeared only because of the equality constraints. It's sometimes convenient to put the equality constraints because we can solve the optimization problem simply, but later on we'll have to come back and then argue that certain parts of the curve cannot be efficient. All right, so very simple idea. In a two-dimensional asset, equality constraint, I can simply set it equal to the target return, compute what x is, plug in the x into the solution for the variance, and I get the nice efficient frontier. Now I want to extend it to a d-asset problem and see how far can I push it. So here's the mean variance problem that I want to solve. Same thing, I want to minimize my variance, but now here's the expression for the variance. It's the covariance matrix sigma ij times xi and xj. I need to make sure that the x's that I consider is a portfolio, so the sum of the x's is equal to 1. And again, as before, instead of putting greater than equal to r here, I am putting equal to r for the same reason, because I have equality constraints and I can solve this more efficiently. In the prerequisite modules for nonlinear optimization, we had introduced this idea of Lagrange multipliers. The problem with this optimization problem is that it has two constraints, and I don't know how to deal with these constraints effectively. So the easiest way to do it is to construct something called the Lagrangian. And the way to construct the Lagrangian is to take the objective function. So this box here is just the objective function. Take the constraints. So this particular constraint is the target return constraint, except that the r, which was on the right-hand side, I set it equal to minus r inside the bracket. This constraint is the constraint that says that the sum of the x's should be equal to 1. That is, they must be a portfolio. And again, the 1 on the right-hand side, I moved it into the left-hand side with a minus 1. And then I multiply it by two multipliers u and v, which are called the Lagrange multipliers. Now, having put the constraints into the objective by multiplying by the Lagrange multipliers, I'm going to completely ignore the constraints. I'm going to say that this is now an unconstrained problem. And we know that for the optimal solution of an unconstrained problem, we have to compute its gradient and set it equal to 0. Now, this particular objective function, assuming that u and v for the moment are just multipliers, they are not unknowns, the decision is in terms of these x's, and there are d different x's. So I have to take the partial derivative of this expression with respect to all of them and set it equal to 0. If you take the partial derivative with respect to I, you'll get 2 times sigma ij xj. That's the derivative that's coming from this term. You'll get v times mu I, which is the term that is coming from here, and minus u, which is the term that's coming from there. And I'll set it equal to 0. I'll have one equation for all i's going from 1 through d. So I get d equations from here. I have two other equations from here. I need to make sure that my portfolio satisfies the target return. And I need to make sure that it's a portfolio. So I have two equations here. I have d equations here. And how many unknowns do I have? I have actually d plus 2 unknowns. Why the extra 2 unknowns? The two Lagrange multipliers, u and v. So here are the original set of unknowns. Here are the new unknowns that I introduce. I have d plus 2 unknowns, d plus 2 equations. I can solve it. And in the next slide, I'll show you how to set up the linear equations to solve it. Here, I'm going to encapsulate this story into a theorem which says that a portfolio X is mean variance optimum, meaning that it satisfies that optimization problem if and only if it's feasible, it satisfies the constraints, and there exists u and v, multipliers u and v, which satisfy these constraints star, which satisfy all of these gradient conditions. And this will become important in a few slides. All right. So here all I've done is I've taken these equations that are there, these D equations, and the extra two conditions on the portfolios and set them up as a one large matrix. So up here, all of these equations are the gradient equations. This equation is the target return equation. This equation is the portfolio equation. So there are D plus 2 equations here, D plus 2 unknowns. All these zeros corresponds to the gradient conditions, that they must all be 0. This R is, of course, the target return. And this 1 is the fact that it's the portfolio 1. So that's some vector B. This is some, I'm just calling this matrix A. And just simple linear algebra tells me that if I take all of these portfolios, this vector, I can compute it by simply taking the inverse of A and multiplying it to this vector P. Done. That gives you the way to compute these portfolios, and this is something that we will do later on in the modules to see whether this is an effective way, whether it gives you good portfolios, and so on. In the rest of this module, what I want to do is give you a little bit more structure on what do these portfolios look like. Is there any interesting structural properties underneath, which we'll use later to derive something like the capital asset pricing model. In this module, we will focus on a single asset, and we would develop a model which takes into account the temporary price impact of a trade and the permanent price impact of a trade, and construct an optimization problem that allows you to select a trading strategy that minimizes the cost of execution and as well as the risk associated with this execution. In this module, we're going to take the approach that we have decided a portfolio that we want to trade towards. So this is a new position. We had an original position, and now we want to trade to a new position. And we have computed this new position perhaps by taking liquidity into consideration and perhaps not. And in one of the pieces of this overall trade, we have to sell a total of capital X shares over at most T trades. I choose a certain number of trades that I can put, and over those trades I want to sell these shares in order to have the least amount of trading cost associated with it. And in order to compute the trading cost, I need to have a model for trading costs, and that's what we're going to develop over this module. So in order to model how I'm going to trade, I'm going to introduce this notion of a trading strategy. So N sub j would denote the number of shares that would be sold on the jth trade. Capital N, or boldface N, which is N1 through N capital T, will be called the execution sequence. It's the complete sequence of execution that I'll be interested in. Over the entire period, j going from 1 through capital T, the sum of all the trades that I made must be equal to x, capital X, the amount that I wanted to trade. I'm going to introduce a new notion of little x, which is going to be the inventory. That is the holdings at the end of a particular trade. So x sub 0 will be capital X, x sub k will be the holdings at the end of not the jth trade, but the kth trade. After the kth trade, I would have sold N1, N2, N3 up to Nk. I subtract that from capital X, that tells me what is the holdings left over, and that's the inventory that I have. In order to understand how to choose these sequences, I have to bring in this notion of what happens to the prices. So let S hat K denote the price per share received for the Nk shares sold in the kth trade. This S hat Nk is going to be a function of all the trades N1 through Nk. Note that it also depends on the trade that you actually put in. And now in the next slide, I'm going to set up a particular model for how these prices behave, and using those models, I'm going to try to understand how I can trade off various important quantities that play a role in the execution of a particular stock. So this slide is perhaps the most important one in this module. I'm going to assume that the price impact, the impact on the price of my trade, is going to have two components. There's going to be a temporary price impact component, which is the impact of trade Nk on its own price per share S hat K. And a permanent price impact is the impact of trade Nk on all the future prices. And here's the model that's going to happen. Remember, I'm selling shares, so whatever I do tries to drag the price down. If I were buying orders, if I were putting it in buy orders, then the whole story will be a mirror image, and I will start increasing prices because of my trade and not decreasing prices. So let SK denote the price that I observe in the market when I am contemplating the kth trade. When I put in the kth trade, the average price that I get for this trade is not going to be SK, but a smaller amount, S hat K. This is the amount of money that I would get per share when I put in the trade H and K. Now, I'm going to assume that S hat K is going to be SK minus HNK. It's something, HN is a temporary price impact function. It defines what will happen to my price, by what amount the price is going to dip if I decide to sell NK amounts of shares. Now, what happens to the price in the future periods? This particular trade NK is going to have an impact of what happens to price SK plus 1, and therefore it's going to start having an impact on SK plus 1, SK plus 2, SK plus 3, all the way up through S capital T. And the model that we are going to say is the following. The price at the next time period is going to be some random walk. So it's current price plus a random walk component. So sigma is the variability or the standard deviation. ZK is just IID, standard normal random variables. So without any price impact, this particular asset is just doing a random walk. If there was drift in the market, we can simply add another drift term. Typically, one ignores the drift term and claims that these trades are happening over a certain period such that the price is not significantly drifting, but it is varying. So SK plus sigma ZK tells you what happens in the random walk. The expected cost term takes into consideration the fact that if I sell a large chunk, it's going to have a price impact and I won't get the revenue that I want. Rho, the term over here, is the trade-off that trades off my concerns for variance with my concerns for trying to keep the cost, minimize the cost that I end up getting from it. The total revenue from execution is simply the price per share for every trade times the number of shares sold in that trade. So it's the sum over K going from 1 through capital T of S hat K, which is the price per share, times NK, which is the number of shares that were traded. If you write out the expression for S hat K, it becomes SK minus the term that corresponds to the temporary price impact times NK. So this term, we have taken it together and kept it over there. Then SK has an expression. SK is equal to S1, the initial price when we started trading, sum from J going from 1 through K minus 1 of all the random walk terms, minus NJ, which is all the permanent price impact terms, times NK. So if you unravel this sum and do it two different ways, you end up getting the first term, which is S1 times the total number that I sold. So this is the revenue that I expect to get if there was no price impact. I can just sell everything all at one go. I get the current price. That's it. I'm done. Plus, I get a term which corresponds to random walk. The random walk term starts to show what is going to happen, what the trade-off between selling and inventory. So the random walk term has a term Z tilde K that refers to the random term at time K, the random walk at time K, and it affects all the leftover inventory at time K. So this is not NK but XK. It's the inventory at the end of the kth trade. Similarly, the term that corresponds to the permanent price impact also is affected by the inventory and not the current trade. So GNK, the trade at time K, is going to affect all the stocks that are not yet sold, all the shares that are not yet sold and sitting in inventory. This is the revenue that was expected. That is the revenue that was realized. So the difference between the two of them is the slippage or the expected cost of the trading strategy. So the trading strategy CN gives me a cost which is GNK times XK, which is the inventory, plus HNK times NK. This is the expected cost, and therefore the term that corresponds to the random walk goes away. The risk or the variance of the trading strategy is that all the deterministic terms goes away. Since the random walk terms were assumed to be IID standard normal, you get sigma squared times the sum of the inventory from time 1 to time capital T. Now we can define what is called the optimal execution frontier, which is a trade-off between expected cost and risk. So I want to minimize over all trading strategies the expected cost plus rho times the risk term. The time horizon capital T is also a variable, but in this particular case, we are going to assume that capital T is given and just optimize over the execution strategy. What this objective is basically trying to do is the following. If I completely ignore variability, then the best thing for me to do is to sell equally across the entire time horizon. That minimizes the amount that I sell on any given day, and therefore it minimizes my price impact. And we will see in the Excel spreadsheet that that is exactly what is going to happen. But if I spread it uniformly, what's happening is that I expose my inventory to very high variability. And therefore the realized revenue could be very far away from the expected revenue. If I want to control the variability, then I want to sell quickly, but then I pay a cost in the expected slippage, or equivalently my revenue comes down. So I need to balance these two, and rho is sort of exploring the different points on the surface that is a trade-off between the expected cost and variability. What are some typical choices for the price impact function? For the permanent price impact function, typically one takes it to be linear. For the temporary price impact function, you can use the Kissel-Glantz function that we introduced in the last module, and we are going to be doing that in the Excel module that we will be talking about very soon. In this module, I'm going to walk you through how to set up this optimization problem that involves a mean term, a variance term, and a liquidity cost term, and compute portfolios or positions that optimize mean, variance, and a cost term. So here's a fictitious example that has been created. I have 10 different assets. Here are the mean returns for these assets. Here's the variance covariance matrix for these assets. And then I also computed the volatilities by simply taking the square root of these quantities and multiplying them by 100. Then I define something called volume. I'm not particular about what the units are. So in whatever are the base units, the volume is 10, 0.1, 0.01, and so on. So the first asset is very liquid, and the third asset is very illiquid according to these units. The other assets are somewhere in the middle, and asset number 9 is the most liquid. It's about 100 units of volume per day. And the tension that I'm trying to build up here in this example is that the illiquid stocks, so this one, for example, has high return. So 7.17% return, and its liquidity is 0.1. 6.75 return, its liquidity is 0.01. So if you exclude concerns about liquidity, you should expect that you would want to hold asset 3 and 4. Asset 6, which has medium, it has 6.289 is about 6.3% return, and its liquidity is around 3. So this one, asset 6, is a good trade-off between both return and liquidity, and we would want to see how things change. Asset 9, which is very liquid, doesn't have very high returns, and so on. So here's the risk aversion parameter that I'm going to be using for my portfolio selection, which is 10. It's arbitrarily chosen. Here are the trading cost parameters. So in my notes, I'm calling them A1, A2, A3. Here I'm calling them alpha 1, alpha 2, alpha 3, just because then I can name them appropriately. Alpha 1 is the factor that hits the normalized trade volume divided by the average daily volume. Alpha 2 is the volatility term, and alpha 3 is just the intercept term. Beta is the power to which the percentage of order to volume is raised, and it's typically around 0.65. So here's my initial portfolio. It's all 10 units on all of these assets, and these are in the same units in which the volume has been quoted. So it's across the board uniform, and just to make things interesting, I'm going to clear this. And keep it as the initial one. What about the trading costs? I'm going to use a formula. It's alpha 1 times 100 divided by B15, which is the average daily volume. And the volume here I'm quoting not in per share, but in the total dollar amounts traded, because I want to keep the units of the portfolio and the units of the volume the same. So it's 100 divided by the daily volume in dollar terms raised to the power beta plus the absolute value of the difference between the initial position and the final position raised to the power 1 plus beta, alpha 2 times the volatility divided by 100 plus alpha 3 times the absolute value of the difference in the two assets. The difference is, just to be very clear here, I'm looking at positions and not at portfolios. So I'm just going to change these names back to all right. So now I'm setting up the optimization problem. The mean return is just the product of the final positions and the mean return vector up there. The variance, take the final position, multiply it by the covariance matrix, and multiply the final positions once again, and that will give you the variance. The trading cost is just the sum of the trading costs across various assets, because I've assumed that the trading costs are going to be separable across assets. What about the objective? The objective is B31, which is the mean, minus lambda times B32, which is the variance, minus eta times B33, which is the trading cost. So the first thing I'm going to do is I'm going to set the trading cost parameter to 0, this eta to be 0. And what does that mean? It means that I'm going to ignore liquidity constraints, and I want to see where does the portfolio selection move the assets. So we should typically see, if I just look at returns, we should start seeing more of an investment in asset 3 and asset 4 because they have high returns, but maybe not completely because of the covariance matrices and so on. So let's run the solver to try to get what it is. And what is solver going to do? It's going to maximize my objective subject to the constraint that the sum of the final positions must equal the sum of the initial positions, and I'm only allowing long positions here, so I'm going to make the variables non-negative. So I solve it, and you end up getting that basically the portfolio gets concentrated in asset 3, about 22% there, 32% in asset 4, 14% in asset 6, which is so this medium one, 16% in asset 7, which has low liquidity, and so on. So this is the final position when I don't take liquidity into consideration. Now let's put eta to be 0.1. So I have medium amount of liquidity constraints in place, and I want to see what happens to the final portfolio. So let's again ask for our solver to solve it. Once again, the problem remains the same, except that now my objective function has changed because eta has been increased. So now, asset number 4, which is not so liquid, but it still has a very high return, you end up still putting about 30% there, but it is much smaller. Whereas asset number 3, which has lower return and much lower liquidity, now you start reducing the amount that you're going to put in there. Asset number 1, which didn't have much of an investment before, but it has a pretty high liquidity numbers, about 10, ends up getting a good proportion. And the last one, asset number 9, which has a liquidity about 100, ends up getting a little bit more position. Let's increase this to 0.5 and run it again. And again, what it should intuitively happen is happening. 6 and 7, which have high returns, their money is being pulled out, and it's being spread across other assets which have high liquidity. And that's pretty much what I wanted to show you in this module. You can take the approach that was by Andy Lowe and others and also set up an optimization problem, which is very similar to this one. In this module, we'll walk through formulating and solving the optimum execution problem that we introduced in the previous video module. In order to set up the problem, I arbitrarily took that the asset we are trying to sell is the first asset. So the volatility of this one was read off from the previous worksheet. And it was the worksheet, the volatility was given in percentages. So I divided by 100 to get what the volatility numbers are. The volume is the typical daily volume that I'm going to be using, and I need these two numbers in order to compute the Kissel glance temporary price impact function. For the permanent price function, I took it to be gamma times n, and the gamma number was taken to be 0.001. The alphas and the deltas, this correspond to the alpha here corresponds to alpha 2 times B1, which is the volatility, plus alpha 3. This one corresponds to basically the constant term in the temporary price impact function. Delta, I took it to be alpha 1 plus the power divided plus beta. This is the other term that is involved in the temporary price impact function, and these two are used to compute what the temporary price impact function is going to be. Okay, I have a total of 1,000 shares that I want to sell. These are the various trades. So in trade 1, in this particular setup, whatever I have, I sell 849 shares, and in trade 2, I sell 104 shares, and so on. And should add up, and so this 1,000, this is a constraint that I'm going to put in my portfolio selection or execution problem. X is the inventory. So before anything gets sold, the inventory is 1,000. After I sell whatever is necessary, this is going to be simply initial inventory minus the trade. Similarly over here, it's going to be now this inventory minus the trade, and so on. So by the end, I must have inventory equal to 0. In the beginning, I have inventory equal to 1,000. All of these trades must add up to 1,000. So given the trade amount, I can compute what the temporary cost is going to be and what the permanent cost is going to be. So the temporary cost is simply alpha, which is the linear term, times the absolute value of the trade, plus delta times the trade to the power 1 plus beta, and the beta turned out to be 1.5 in this particular case. And that has been read from the worksheet mean variance liquidity. What about the permanent cost? Permanent cost is going to be the linear term, so it's gamma times the trade times the inventory, because any trade that I do, its permanent price impact affects all the inventory that is there at the end of the day. So that's what that term is going to be. The variance is simply going to be inventory squared times volatility squared, and that's what I'm going to sum. So the total trading cost is going to be the sum of the temporary cost plus the sum of the permanent costs. The variance is going to be just the sum of the variance terms. The objective, I've set it to be basically the sum of the trading cost plus rho times the variance. And this is what I want to minimize. So let's start with rho equals 0. So I'm completely ignoring variability in my calculations, and I want to see what is going to happen to my execution strategy. When we talked about it in the module, we said that because I don't care about variability, and the temporary price impact and the permanent price impact get minimized when you do equal, we should end up doing uniformly. And let's see whether that ends up happening. Here are my constraints that I want to minimize the objective, subject to the constraint that the total amount of stocks that I sell must equal 1,000. I had to put this extra constraint that any trade is going to be less than the initial inventory, just to keep the optimization problem bounded. I also made it all the unconstrained variables to be non-negative, which means that I cannot put an opposite trade. I can't, when I'm trying to sell, along the way I'm not allowed to buy. But this is something that's worth exploring and may at least lead to some lower cost, but I'm ignoring it. And now let's solve it. So when you started Solver, it didn't give you exactly what we expected, and that's because this is a nonlinear problem and the Solver doesn't get you exactly the solution that you're looking for, but it is going towards the solution of uniform trades. It's over 100 shares over all 10 days, totaling to 1,000 shares. Now if I put rho equal to 1, which means that I'm starting to value variability and I want to minimize variability, but the weight is around 1. I solve it now. So you end up getting front loading. The optimal solution for this should be completely monotone, but it's not exactly. Towards the very end, you see 0.50, 0.53, 0.66. It should be monotone, but because it's looking for a local minimum, it didn't exactly find it. Now, if I increase rho to be 2, then it should try to reduce variability even further, which means that it starts front loading and pay the cost that is necessary for it. So now about 912 shares that you end up paying. which goes to give you a very high temporary price impact as well as a permanent price impact, and that's the cost you pay because you want to reduce variability. And pretty much that's what I wanted to show you in this particular worksheet.